watching NDTV Profit and this is Your Money Matters. I am Mahima Vachrajani. Today, we are going to discuss ETF versus index funds, and to discuss this in a detailed manner, we are joined by Udayan Adhe, who is the founder at Udayan Money. Thank you so much for joining us, Udayan. First and natural question that comes to me, when we discuss this topic is, of course, how is ETF different from index funds? For our viewers' context, give us that difference, and which one of this is better in which situation? That's the answer that I'm looking for.
Absolutely. Thank you so much, Mahima. Good morning to you and to all the viewers. So yes, I think ETFs have really become popular in the last few years, right? I think with the proliferation of apps that give you easy access to invest in them, demat account proliferation, ETFs have become popular. But what is the exact difference between the two? At the very heart, both are trying to do the same thing, which is replicate a pre-decided basket of investments, right? So think of, let's say, a Spotify playlist. Right? So if the Spotify playlist is of hot new Hindi songs, you definitely know that that song will not have Kishore Kumar songs in it, right? So exactly in the same way, when you select an index fund or an ETF, you know by its name what that particular investment and where it is happening. So for example, if it's a Nifty 50 index fund or a Nifty 50 ETF, you know your money is going to be invested in amongst India's 50 largest companies, right? Which is a Nifty 50, which is the index. So the entire job of an index fund and an ETF both is to absolutely replicate how the Nifty 50 performs. So if the Nifty 50 goes up by 10%, the ETF and the index fund, they also, in an ideal world, have to go up by 10%. So, and the other way around as well, right? When they fall, the fall also has to absolutely mirror that index that the ETF or the index fund is tracking. Now, with respect to the difference, this is where the underlying sort of back-end operations change. So with an index fund, it is a mutual fund, right? So you don't need a demat account for it. And for all purposes, in the literal and in metaphorical sense, it is a mutual fund. But with an ETF is listed on the stock market. So it operates like a stock. So the classic difference from a very practical standpoint is that when you buy a mutual fund, you can't really time the price of that mutual fund, right? Because when you buy a mutual fund, the cutoff order goes at 2 p.m. So whatever the price is at 2 p.m., you'll get that price.
Right.
But for an ETF, its price is changing every second on the stock market.
Correct.
So you can, as if you think that the market is potentially going to rise or it has taken a big beating, you want to buy it at a lower point. That is when potentially an ETF could be a better idea. But at the end of the day, both are doing the same job, right? You're investing in a particular themed investment, a themed index, and there's two different ways to go about it.
Got it. That's a very comprehensive answer, for everybody to understand as to what's the difference between ETF and index funds. It's, at the end of the day, it's the same, but ETF is it's listed on the stock markets, and so you directly invest in them. But index funds is a kind of mutual funds. That's a summary of what Udayan said. In terms of both of these, I'll go one by one. What are the parameters that you check, while buying an ETF, and what are the parameters that you check while buying an index fund? And if there is a difference between the two when it comes to checking the parameters as well. One of them, as you rightly mentioned, when you talk about ETFs, they have to mirror the index, right? So the tracking error where, the tracking error where ETFs is the least is where, ideally you should go for. So give us those parameters, and if there is a difference between the two, what is that?
So broadly speaking, the parameters are the same except for one point. I'll first go through the common parameters, right?
Sure.
So one is, as you rightly said, the tracking difference, which essentially means the gap between the returns of that index and the returns of the ETF or the index fund that you are investing in. So that gap should be as close to zero as possible in an ideal world, right? Because the entire job is to absolutely mirror the index that the fund or the ETF is tracking. Now, the second thing which is also important is the amount of money you pay to the ETF or the mutual fund to help you sort of just invest this money, right? So the expense ratio of the ETF or the index fund. Generally, when it comes to investing in such passive instruments where there is no fund manager deciding through research and through other techniques where to invest, generally the expense ratio, the fee that you pay to anyone should be as low as possible. So again, we first went through tracking difference, which has to be as low as possible, then expense ratio, which has to be as low as possible. And then the third thing, which is again common for both, is just the reputation of who's offering that index fund or ETF, right? You want to go with a good pedigree brand just because, they have the bandwidth, they have the resources to pull in. Potentially, they have also had experience of having an index fund or an ETF in the same space.
Right.
The one difference where ETF selection kind of changes a little is the amount of money that the ETF manages. Obviously, for an index fund as well, you want generally to invest in an index fund that has a larger AUM. But with ETF, that becomes even more important because when you're investing in an ETF, because it's traded on the stock market and because its price is changing every second, if that ETF is not liquid, if it's not having enough money, then there's always a problem that, let's say, you're buying at a price that is 1% higher than the actual index. And this is the spread difference. That becomes a big factor when it comes to choosing which ETF to buy. Generally, the more liquid the ETF, for generally retail players who are investing not humongous amounts, right? Not many crores. It doesn't really matter if you invest in an ETF that has 5,000 crores vis-a-vis 3,000 crores. But if an ETF has, let's say, 20 crores, 100 crores, then that becomes a challenge because you may find slippage, right? You want to invest at a particular price. By the time your order goes through, it's at a higher price, which is for all purposes a loss that you incur, correct? Because when you have to sell that, you could sell it at a price closer to the market.
Absolutely, absolutely. That completely makes sense. Now, since you mentioned the parameters to invest in, the difference, the one difference between the both, I also want to know that, let's say, for example, if one of our viewers, or let's say, if I'm saving 20,000 a month, would you suggest that one should invest? We'll go with ETF first, because do you suggest an SIP in an ETF? Or do you think that a lump sum amount should be invested in ETF? And if it is lump sum, what portion of your total investment should be a part of your ETF? And if it is SIP also, let's say I'm doing a 10,000 SIP every month, what portion of that should go to ETF?
So I am a big believer of index funds over ETFs for a few very straightforward reasons. You mentioned SIP, Mahima.
Right.
So it's very certain new age platforms offer you SIP options in an ETF, but it's not very straightforward. Whereas you can completely do an SIP, that is an automated investment every month in an index fund. And I think that's a game changer, right? Because just imagine you take 5 minutes of your you take 5 minutes of your day, and that's all it takes to set up that index fund SIP. So like clockwork, let's say every fifth that you have decided, the fifth of every month, that money gets deducted from your account, gets invested. The problem with an ETF is because you can't do an SIP in ETFs, it's going to be very tricky, right? Because let's say you have decided to invest 10,000 rupees every single month on the 5th of every month. And just as you're about to invest, you get a call from your boss and he or she is telling you that, okay, this has to be done, and then you forget about it. Or something that's even more common that I keep seeing all the time is that the benefit of an ETF is that you see the stock price or the price of that ETF change every second, every minute. That's also a big disadvantage because imagine you are investing on the 5th of the month and now the ETF is down 2% that day because the markets are down 2%. So then you delay potentially investing because the human mind is very conveniently takes a reference point and says, okay, what if it goes 2% down further? What if I can get a bigger bargain? And in the process, what ends up happening is that you just keep waiting and people just keep sitting on money, they don't invest. And a lot of wonderful studies have been conducted in this space where if you try to time when you do an SIP, whether it's just one, whether it's the first of every month, whether it's the highest point in that month or the lowest point in that month, the difference is less than 0.25% over a 5-10 year period. So, so that's why I'm a big believer in SIPs because they are very simple. I love just executing simple things when it comes to setting up your finances, setting up your investments. ETFs, again, the big advantage of ETFs, as I said, is you can track the price and you can time that price for that day if you think the market has fallen down. But again, the problem with that is on days when you can actually take advantage of that. The classic example, the most recent example being the election day week, right? Markets were moving up and down wildly for 2 days. when people tried to buy ETFs or they wanted to invest by when the market was down 5% intraday,
Right.
the problem was that the ETF was actually trading at a premium. So the market was down 5%, but the ETF, if you purchased it that day, wouldn't have been down 5%. It would have
Correct.
been down 2.5, 3%.
Right.
So because of all of these, because ETFs, I think just complicate the behavioral aspect of investing. I'm a big believer that SIP investing in index funds is the way to go instead of investing via ETFs.
Okay, perfect. That sums up very well. But of course, one more thing. Like I mentioned, that if I'm investing 10,000 every month, that's my savings overall. How much of that portion should go to an index fund?
So, if you look at the Western literature, they would tell you that index funds outperform any actively managed fund. And again, just to go down to the basics, an actively managed fund is where a fund manager would, through their own research team, decide where to invest. So they'll try to find hot picks. They'll try to find, as per their philosophy, as per their research, which are the sectors that they should be investing in, which are the stocks they should be investing in, and then they put money there, invest the money there.
Right.
With an index fund, all the fund manager has to do is invest in a pre-decided selection of stocks.
Correct.
So with an index fund, as per Western data, these index funds do not beat actively managed funds.
Correct.
In India, though, it is slightly different. If you just look at AMFI data, in 2018 is when SEBI created the classification of mutual funds that we now see of what is a large cap, what is a mid cap, what is a small cap, what are the various categories, what is a multi-cap fund. If you simply look at data from that time, you would notice that over 50% of the times, actively managed funds have beaten their respective indices.
Right.
And in the past year, if you look at, again, multi-caps, large caps, that is over 80%. That's over a two-third over a 3 and 5 year period for these categories as well. One category where the outperformance isn't as significant is mid-caps.
Okay.
Where over a longer period, that about a little less than 50% of mid-caps underperform the index. So in terms of answering your question, right, I went through multiple scenarios here. In terms of answering your question, what I would recommend is just have one index fund, one or two index funds in your portfolio, but also mix it up with actively managed funds.
Right.
That are not investing in the same place. So check the overlap of your portfolio across different funds that you're investing in. There are plenty of free tools available online that will help you do that. And I think a blended strategy is a wonderful way to go about this investing instead of just sticking to only actively managed or only index funds.
Got it. But let's say 20% is the right proportion to be invested in index funds and the rest in actively managed, or that percentage should be higher than 20%.
I think anywhere between, look, for all you know, right, if you have an only index fund portfolio, you're not going to go wrong. Because over 10 years, as the index grows, you're also going to make your money as the markets are growing.
Right.
But okay, if you have to get into the specifics, I would say anywhere between 20 to 33%, right? So 1/5 to 1/3 of your money going into index funds. The rest in different category, different style actively managed funds, I think could be a very good way to go about it.
Right. Also, in terms of these index funds, because they track different indexes, do you have a preference as to which index fund do you generally pick? Is it Nifty 50? Is it Nifty Next 50? Mid Cap 150? Small Cap 250? Which is it?
I think Nifty 50 is the most popular one, right? India's 50 largest companies. You get exposure to essentially a big slice of the Indian stock market just through one fund.
Right.
I also, with clients as well, we've been adding a lot of factor indices funds or factor index funds. So I think a couple of very interesting factor indices are the Nifty Mid Cap 150 Momentum 50 Index Fund. Complicated name, but what it does is out of the 150 mid cap stocks, it selects 50 with the strongest momentum. By momentum, the classic Gujarati phrase, right? Bhav Bhagwan che. So price is God. It just selects stocks with the highest price momentum, and across every certain set period of months, it flips the portfolio because it rearranges the portfolio. So I think that's an interesting fund. Historically, the index funds that track it are relatively new. I think the oldest one is about 3 years old now, a little over that. But if you look at historical data since 2005, then the momentum index fund in the mid-cap space has actually done better than the Nifty mid-cap 150, consistently on a rolling return basis across 5 and 10 years. Right. So I think that's an interesting index. Also, I feel value indices, so the Nifty 50 Value 20 Index could be a good idea. That is an even newer category when it comes to which funds are tracking it. So I think exploring factor indices, strategy-based investing, I think could be an interesting approach because that gives you access to potentially areas that actively managed funds aren't targeting right now.
Right.
Because there are certain momentum actively managed funds, but a momentum mid-cap actively managed fund, you'll have to find one.
Absolutely, and in fact, there was a data out there. I don't remember the numbers exactly, but all of these, factor-based index funds that you're talking about, the momentum funds especially, were the worst hit when markets have fallen, but have bounced back even better, post the market recovery. I don't remember the exact source of the data, but I'd read that somewhere else as well. Okay, now, right now the market situation is such that, everybody is worried. Right, and but as compared to Indian markets, global markets are still doing better. There are options when it comes to investing in global ETFs as well, but there are some ETFs that have closed fresh issues coming in. What is your view with respect to investing in global ETFs, and if one wants to go about it, how should he or she choose the global ETFs out there?
So most of the popular indices that you could invest in from India through mutual funds, they have now basically there's a country-wide limit on how much money can be invested in these funds, and we have hit that limit. So unless that limit is officially changed by the RBI, then we can't invest in them. So the two ways to potentially invest in global markets are through investing in actively managed funds. So the way this works is an Indian mutual fund house, an Indian AMC, ties up with a foreign mutual fund, and this creates a feeder fund, right? So you invest in one fund, and that invests in the foreign fund. So it becomes a fund of fund. That's how it gets its name. When you're looking at this online, the small abbreviation that you will see is FOF. So it will have the country name and then FOF followed by it. So here in this case, what you should check is the underlying fund, how that is doing, right? Because that is the important metric there. The second way, where you can sort of, in a way, still invest in ETFs through India, even though there's a nationwide limit, is by opening accounts with, again, Indian entities that have tie-ups with global brokerages, or some global brokerages also operate within India. You can open accounts with them. Now, in that, there are a few factors that you really need to be careful about. Firstly, currency difference, right, or transaction charges, because the moment you are converting your money from, say, rupee to a pound, rupee to dollar, or any other currency, there are charges involved. So that fee, that spread could eat into returns. So you have to be careful about that. Secondly, there's a limit of $2.5 lakh, $2.5 lakh, so that's 250,000 US dollars, on how much you can invest overseas in a year.
Right.
Again, most Indians, you wouldn't hit that because the portfolio size for that has to be really big. My strategy here would be, just while setting up a portfolio, the good principles are to have about 10 to 20% of your money in different parts of the world. Just from an asset allocation perspective, I wouldn't go too crazy with it as well, because you're venturing into unknown territory, so that might be scary. But I think these two options could be good ideas.
Right, and then as you rightly mentioned, a lot of these funds have reached their limit in terms of investing. But are there any funds still which are open in terms of investing? And if any of these funds that you are finding attractive at the moment, that people can, go ahead and make some investment?
I think two regions that are, so first of all, not a lot of areas of the world are accessible through Indian mutual funds to the fund of fund model.
Right.
Amongst the bigger nations, the US, Greater China regions, I think those are hot areas. I think the Edelweiss Greater China Fund, these are not recommendations, but that tracks the Greater China region. China has been seeing a resurgence in the past 6 months. They announced a big stimulus plan, which has brought in a lot of money into the Chinese market. Some semiconductor stocks are up almost 50%. Other industries as well, they have got big stimulus plans. I think it's $800 billion, in excess of that, in fact, as a part of the stimulus plan in China. So I think the Edelweiss Greater China Fund could be a good option if you want to get exposure to the Chinese space. Then there is one global fund that, again, if you look at historical returns, you'll be very disappointed. But if you again want exposure to the global markets, there is the PGIM Global Equity, Global Opportunities Fund. That could be a good option. If you want exposure to the US tech market, then you can invest in the FANG Plus ETF, the Nasdaq in the actively managed fund space. There's a Edelweiss US Technology Fund, which invests in a JP Morgan underlying fund. So opportunities are there, but I think at times we have to sort of define our plan and then proceed accordingly.
All right, quite a comprehensive answer then. Even when it comes to commodities, gold and silver ETFs have also picked up. Before I move on to the question that gold has already risen so much YTD, year to date, will it be wise enough to invest in those funds? I'll take that question later, but if you want to, allocate some portion of your portfolio to these gold and silver ETFs, should you, first of all? And if yes, what are the parameters that you check and what portion should you be investing in them?
So the parameters are very similar when it comes to, what is the expense ratio of that ETF. Again, free websites online allow you to check this. In fact, the NSE, BSE have mandated ETF expense ratio now to be public. So you can check that out. So the expense ratio ideally should be as low as possible. The tracking difference should also be as low as possible. And again, there should be liquidity. So again, very similar parameters. And fourth is pedigree of who's offering it. So it ideally should be a bigger brand name. Now, when it comes to whether you should invest, how much of your portfolio should you invest in these commodities, I'll again go back to the basics. Instead of trying to time what is happening in the stock market, if something is going up, that doesn't necessarily make it a good investment, right? So just from an asset allocation perspective, I think, again, having 10 to 20% of your money in gold could be a good idea, right? Because it provides some cushion. This hasn't been always true, but gold at different points has performed the exact opposite of the stock market, right? So the correlation between the two assets historically at different points has been quite low. Very good example of what's happening right now, right? The Indian market has taken a beating in the past 6 months, but gold and silver have actually increased during that period. So by having, again, different pockets within your own portfolio, whether it's Indian equity, then about 10-20% in global equity, 10-20% in commodities. What that does is that during market downturns, it can keep you a little sane. It can make you less anxious because there are certain pockets of your portfolio that are doing better than others. Inverse of that is that when certain pockets are doing well, there'll always be pockets that don't do well as well. So overall, you have to be okay with that. And I think adding gold ETFs, silver ETFs could be a good idea. Again, my preferred approach there is instead of having a gold ETF or a silver ETF, pick a gold mutual fund or a silver mutual fund. The way this works is that same mutual fund is investing in an ETF at the back end.
Correct.
So that's again, for all the reasons I mentioned before, why I prefer index funds.
Yeah.
The same reasons applies to why I prefer gold or silver mutual funds as well. And over there, one quick point, how then do you decide which gold mutual fund to invest in or silver mutual fund to invest in?
Right.
Similar principle, because with a gold mutual fund, what ends up happening is that because it's investing in the ETF, the fee that you pay is the ETF fee plus the gold mutual fund fee. So the difference in the two will be about 0.15% per year at the most. So we have to be aware of that, but I'm completely okay with paying that amount because that just helps me automate my investments. So I'm personally okay with it, and that's what I tell people around me as well.
All right, quite a comprehensive roundup. Just one last question. Now that gold has risen so much already year to date, do you think that if somebody wants to invest a lump sum amount in a gold ETF, should they, or what do you think? This is not the right time.
So if you look at the Nifty and gold ratio chart, it's not like we are at historical high levels for gold. If you compare Nifty versus gold from a ratio perspective, but that doesn't mean that gold will keep rising. There are theories that say that gold will rise. There are theories that gold will stay stagnant or even fall. Again, instead of trying to figure out what will do better the next time, which I am not at all in the business of, right? Because making a prediction, if you're right about it, you just look smart, but then next time you could just very well be wrong. Nobody knows what's going to happen. So I think this going back, sticking to the principles where you decide on the percentage. Let's say it's 15%, right? 15% you want to invest in gold, and then just keep at it with that plan. 3 years later, let's say instead of 15% gold being a part of your portfolio because gold has done well, now it's 20%.
Right.
3 years later, you can just sell some of the gold, buy into what is not doing well. So you
Right.
rebalance your portfolio that way. But again, trying to look at past returns, past 1 year returns is almost never a good idea.
Absolutely.
So
Absolutely. Never a good idea for a long-term investment. And that ends our conversation on a perfect note. Thank you so much, Udayan, for giving us all those insights. I'm sure this is going to help our viewers, perfectly and to a lot of extent. So thank you so much for taking our time and speaking with us at NDTV Profit.